I should start by explaining what I mean by narrative reporting, as it's not really a well-defined term. It's sometimes a very UK-centric term, so I refer it to being information that's in the front half of the annual report, so incorporating corporate governance as well as management commentary. And it's really the piece of information that gives you a forward look as compared to the financial statements, which are a little bit historic and based on past performance. Now, in the UK, back in 2014, the UK government introduced the strategic report, and many of you will be familiar with the operating and financial review which preceded it. So the main change was that we had a new report which contained similar content to the operating and financial review, but the aim was really to focus the minds of preparers on the strategic issues that impact the company. And the strategic report is a fantastic development from the government, and it brings together both financial reporting, so in terms of it contains a financial review of the numbers which we're used to, but it also has non-financial reporting integrated within it. And we've seen, particularly over the last few months, a lot of focus on alternative performance measures and non-GAAP measures. And again, this is a term that is not well defined, so there's various initiatives out there from the European Securities Markets Association, the International Organisation from Securities Organisations, as well as people like the International Accounting Standards Board, are trying to get to the bottom of this question of what is an alternative performance measure. And what you typically see in the annual report is retail square footage, for example, or other non-financial metrics. And we do quite a lot of outreach with investors at the FRC, and what we are hearing is that investors do find these non-GAAP figures useful. The main area of challenge that we get is often there's no clear reconciliation to how some of those numbers are derived from the financial statement. So we're seeing a lot of adjusted numbers being reported, adjusted profits and the like. And reporting is getting bigger, better, evolving, but one of the things that we have been facing over recent years is an increasing reporting burden placed upon companies, and we hear it frequently companies frequently say to us, when is this going to stop? You know, when are regulators going to stop adding new requirements? And how do we contain this? And then on the other hand, we hear investors saying that we're not getting the right types of information. So the FRC a few years ago launched its Clear and Concise initiative. Now, this is not a new regulatory requirement, it's not about regulation, it's about making the best use of what we have. So the aim of this initiative is to ensure that annual reports contain relevant information for investors, and to ensure that they're written in a style that is understandable. So I've read the annual report of a leading bank, which is rather large, and as someone who has some experience in the banking industry, I found it really difficult to understand what the key messages are. So Clear and Concise is really about making those key messages readily available and understandable to the readers of the annual report. Regulatory change has been one of the drivers of the changes that we're seeing in corporate reporting today. And although we do get complaints about too much regulation, sometimes regulation can be a catalyst for change. And over the last few years, we have seen a number of initiatives that have helped focus the mind. So in 2012, as part of the UK Corporate Governance Code, the Financial Reporting Council introduced a principle that annual reports as a whole should be fair, balanced and understandable. And that has been really, really powerful in terms of ensuring that boards engaged early in the annual reporting process. So thinking about the concept of integrated reporting and integrated thinking that Jonathan spoke about earlier, it's about thinking about the annual report as a whole document rather than the separate elements of it. And this has been really powerful. When we first introduced it, we got questions like, well, what do you mean by fair, balanced and understandable? And could the FRC please go away and define what you mean? And our response to that was their plain English words and sort of applied in a principles-based way. Have a look at the Oxford Dictionary, and you'll. We weren't quite as blunt as that, but we encourage people to think about those things. And balanced is really important because when I look through annual reports, sometimes the front half is very much of a marketing document, so it's always showing a glowing picture of the company, whereas you might see from other types of press releases that perhaps the company is not doing so well, and based on that knowledge, the information in there is often has a marketing type element to it. So is there an appropriate balance of the positive and negative aspects? And there is this continuing drive towards transparency, and what investors are looking for is transparent, honest reporting. They know from other communications that they have what's gone on, and so they want the annual report to reflect that as well. Then in 2003, we saw some substantial legal changes. So the first was the introduction of the strategic report. And the director's report still remains in place, which is another component. But a number of the disclosures from the director's report were moved into the strategic report. And there was also the introduction of remuneration reporting regulations. And really on these, the jury is still out because preparers are finding these in particular a particular burden. And they've not been as effective as we hoped. The strategic report has been more successful, so companies have used that as an opportunity to make changes steered on by the legal change to the law, which has been really great. Then in 2014, we issued the guidance on the strategic report, which first of all, it expands on the content that's in the law, but we wanted to go a step further. So one thing I didn't think I'd be talking about was behaviour in accounting, but we are trying to encourage behavioural change in the way companies report. So you may recall that the FRC had an initiative called Cutting Clutter a while ago, which then morphed into Clear and Concise. And basically one of the observations was that sometimes annual reports can be seen as a bit of a compliance document. There is a tendency to apply checklists. Back in my audit days, I would go along with my disclosure checklist and request clients to put in more and more disclosures without actually thinking about whether that information is relevant or material to a particular business. So we expanded the guidance to include some principles for good communication in reporting, and also encouraging companies to improve their reporting in other ways, which I'll go into more detail shortly. And then in 2015, we issued, as part of the Corporate Governance Code, the viability statement. And this is really centred around the idea of companies taking a broader, longer-term view of their performance and what are the risks that the company is exposed to that could potentially affect their long-term viability. And both the IRC and the FRC have a common objective in that we want companies to be thinking more broadly over a longer period of time over things that may potentially impact their business performance. And this was really sort of one of the thoughts behind the viability statement. It's only been the first year, so we are still waiting to see how companies are reporting against this, but we will be keeping an eye on reporting in this area. And then in terms of the strategic report itself and the FRC's guidance, there are really three core elements. The first is the content, which is largely driven by the legal requirements. That said, it's very helpful that the law is principles-based and doesn't go into a lot of detail, which enables companies to have quite a lot of flexibility around how the information is reported. Then we have some communication principles, and then we focus on materiality. Again, one of the keys to cutting clutter is to focus on the material information for the audience. And the FRC's guidance had really three objectives. The first was to really focus the annual report on the primary audience, which is shareholders as set out in the law. And so that was one of our first objectives. And really, some of the feedback we were getting was that annual reports are trying to do too many things. One document cannot serve the purpose of multiple users. And I think this is a debate that still needs to be had, because there is no consensus on whether the annual report should be for shareholders or a broader group. So this is something, the thinking is evolving, it's likely to shift. But it was getting to the position where everything cannot go in the annual report, otherwise the postman won't be able to get the report through the letterbox. So that's one of the thoughts. And then the other idea was to really give the power back to companies and encourage them to be innovative with annual reports and reporting, because although there is a regulatory framework in place, there is a lot that can be done within that framework. So again, the concept was it's all about, the front half of the annual report is all about telling the company's story, and does the narrative tell the company's story effectively? And the final principle is very similar to the concept of integrated thinking and integrated reporting. Is the annual report as a whole a cohesive document? Is the information in there linked? And again, moving away from each piece of the annual report is different. Does the business model flow through the document? So there is a relationship between the company's business model and the financial statements, and how is that story being told across the report? And to emphasise this point, what we did was we put a picture in the guidance, which is an unusual step for a regulator. And I had quite a few challenges trying to convince the various boards and committees to let me put this picture in. But really, and appreciate some of the detail might be hard to read from the back, but it's really to say that the strategic report doesn't exist in isolation from the rest of the annual report. There are a number of components of the annual report that are driven by law, but they're all related. They might have different objectives and purposes, but they are all linked. Coming back to the content is the very foundation of this strategic report. And we're seeing quite a lot of literature, both in the academic world and elsewhere, on reporting on the business model. And this is one of the most difficult areas to explain. So the way we've described the business model is it's essentially about what the company does, how it generates value, what makes it different. And we've described strategy as being the path the company takes to meet its objectives. And we did quite a lot of research in trying to articulate the business model and strategy into a few words. And we had so many debates around the table about whether a business model should come first or strategy, and what makes strategy different from business model. And there are various sort of views on this, and certainly you may have come across different ideas on what is strategy and business model, but these are very important concepts which underpin the whole of the annual report and where the company is going. So those were introduced through a legal requirement, but many companies were already explaining what their business model was even before the regulation came in place. So the other important element is the principal risks, and all of these items are all related. So it's thinking about the risks to the organisation in the broader sense. So it's thinking about what are the non-financial risks that may potentially impact the business, as well as the financial. So for example, interest rate risk for a bank. Is climate change a principal risk for a fossil fuel company perhaps? And it's this broad thinking, and it's also thinking about tying it back to the business model concept. So if you're in a business that's in a particular industry, what would you expect your principal risks to be? And then the thinking about key performance indicators or alternative performance measures or non-GAAP. How does management view the performance of the business? What are the indicators that management uses to measure the performance of the company? So it's tying this idea of broader performance reporting together. So that's the content, which again integrates the non-financial information element of it. Turning now to the communication principles, these are written in the context of the strategic report, but can have broader application. So fair, balanced and understandable is one of the key principles, as is conciseness. So we describe conciseness as not just about making your report shorter, but using fewer words to explain the key messages. So that's one of the key principles. The front half of the annual report is meant to be more forward-looking than financial statements. So how does management view the development of the business as it goes forward? And then we put in a principle about reporting entity-specific information, and the quality of annual reports has improved significantly. One area that remains to be improved is the idea of what we call boilerplate disclosures, and so a number of companies are still cutting and pasting disclosures from another company and not tailoring the information to their specific facts and circumstances. So this is something that we're really encouraging. And then linkage and also having the right structure and presentation. We also added something in about the annual review of content. So over the last few years, we have just seen more and more being added, whether that's through regulation, by companies, and it's been an additive approach. And both in terms of regulation, nothing ever seems to get taken out, it just seems to be more. And equally, when companies are reporting, we're encouraging people to go through the process to say, is this disclosure still relevant for its time? So for example, thinking about sovereign debt, in 2008, a number of companies did include disclosures about this. A few years on, is that still relevant to have that in? So that's one of the principles that we have. And the other area of communication is the placement of information. And this is an idea that we've been thinking about for a while. And it's really to say, is there an opportunity to consider the traditional structure of the annual report? Does everything need to go in one place? And things have moved on. Most people, including myself, still think of the annual report as a printed document that you can print and read. Times have moved on. People use data and information in very different ways now. So is there really a need that everything has to be in one place? And every new disclosure that's introduced, does it all have to be in the annual report? And so we needed some principles for when things are in or out. And basically, we introduced terms called cross-referencing and signposting. And this is both to encourage companies to experiment with the structure of their annual reports within the document and outside. So one of the principles that we have is if the information is relevant for investors, the most appropriate location would be in the annual report. If it's of interest to a broader group of stakeholders, perhaps put it elsewhere. Similarly, I talk about investors as if they're just one person, but they are a very broad group. So there's those which I call the data-hungry investors that want everything. They want the detail. They want to be able to populate that information into their models, and they do want that information. But if you've got your retail investor, someone who doesn't know the company that well, they're looking for something different, a quick read. And how do you accommodate both of those? So we're encouraging companies to make use of online web reporting, and also if there's a feeling that information could be better presented in a different way. So for example, the accounting policies, some companies have been experimenting that the accounting policies are with the notes that relate to the policy, and it's been quite successful. So, but it's again up to the company to represent its story in the way it feels the most appropriate. And interestingly, this is all permitted within the regulatory framework. So we work quite closely with the government to make sure that anything that we do issue is not contradicting what's in the law. And all of these things are permitted. So the more detailed information where it's not material can go elsewhere. And then thinking about materiality, this is a very difficult area, particularly in the context of non-financial reporting. It's an area where we still do not have an agreement about what exactly it means and what is material information. Companies do want more guidance in this area to help them make the decisions as to what's material and what's not. It's also a place where there is reluctance to take information out, and sometimes that is driven by the regulatory regime. So one comment I often get is we have a corporate reporting review team which reviews annual reports, and there is a fear that if they take something out they may be challenged by a regulator, for example. And that's certainly not the case, because when I talk to my colleagues, we have exactly the same view on materiality. So if something's not material, they're not likely to raise it. And then there's also internal challenges of taking information out. So one of the keys to concise reporting is to ensure that everything that goes in the annual report is a concise communication of the information. And the law already has some words that sound very much like the accounting definition of materiality. It just expresses them as differently, such as to the extent necessary, key, principle, and these are all signals to say, information can be only information that's material needs to be in there. And thinking about non-financial reporting in a little bit more depth. So this is something that is gaining traction, certainly over the last few years. There's already a requirement in the strategic report for companies to disclose material non-financial matters. Again, this is because it's such a new area. We don't quite know what non-financial reporting means. So terms that are bandied around are CSR reporting, ESG, environmental, social, governance reporting, non-financial reporting, and there's no agreed definition. My understanding of it and the way I interpret it, and this is based on conversations with investors, is basically those matters, broad matters that are not typically financial but could potentially have an impact on your financial performance in the future. So one of the latest debates that we're thinking about is the impact of climate change risk, and what is the impact in terms of both the accounting, is there an effect on things like stranded assets, but also has a company in a particular industry thought enough about this in terms of their principal risk reporting, because this could potentially, in extreme circumstances, affect the future viability of the company. So it's thinking about this broad range of information. It's really an interesting area for me, but we are facing the situation where we are seeing an ever-growing number of frameworks in this space. So there are a number of organisations involved on single issues, so human rights, climate change, and others. So things are changing here. There's also a requirement already to disclose greenhouse gas emissions, but non-financial reporting does have an effect on other disclosures such as principal risks or your key performance indicators as well. Now, one of the challenges has been on non-financial information is to where do we and how do we accommodate this non-financial information. And there, although I speak about investors, there is a need for information for a broader group of stakeholders. And things have moved on that is recognised and acknowledged. And we've come to the conclusion that it will be difficult to have all this information in one place, otherwise we are going to end up with an encyclopedia of an annual report, which is going to be a bit of a challenge. So having said that, investors are also becoming more and more engaged in the ESG debates, and they are very clear that non-financial information is relevant to them when it could impact the performance of the business. So they are expecting to see more in the way of reporting in this area. And companies have for a number of years been doing separate corporate social responsibility reports which provide more detail, but there is a case that there might be some information in there that does need to be promoted to the annual report as it is relevant to investors. And we set out those principles in the guidance on the strategic report. And one of the things that we also do is we influence broader developments in narrative reporting. So we've seen a number of developments arising from the government's political agenda. So gender pay gap reporting has been a recent development where new regulations are currently being introduced for employers to make an assessment of any potential pay gap. And this is a really useful disclosure in terms of achieving the policy objective, but it is meant for the primary audience is the employers. So we've recommended that perhaps it would be better if this information was reported on a company website. And the government are thinking of reporting outside using the web, and it links to the broader debate about how electronic reporting can be best used, given that it's there and it can provide the drill down facilities. And then just thinking about the current issues that are on our agenda. So tax transparency has been all over the press, Panama Papers, and there are various impacts both in terms of accounting and in terms of the front half. So we are seeing a number of initiatives. So for example, the European Commission is currently consulting on country-by-country tax reporting, and there are calls for better disclosure about a company's tax strategy in terms of the narrative. So that's something that we are very much thinking about. And I'm looking forward to one of the presentations this afternoon, because another emerging area is the area of human capital reporting, and how do we account for intangible assets such as the people, the task force. And this is, I think all these areas can be a little bit challenging in terms of they are difficult to measure in traditional accounting terms. They have a value on them, and how do you place that value and ensure that that value is communicated through reporting. And in terms of the horizon ahead, my thought is that non-financial reporting is continuing to evolve, and it will be more and more increasingly be seen as an integral part of corporate reporting. Jonathan spoke earlier about thinking about the business's impacts on society, and that's going to be, and I think it's very important for businesses to be accountable to a wider group of people, and reporting will clearly play a part in that. So I always see this as a twofold exercise. So detaching the governance elements from the reporting is not always possible. I think good governance goes hand in hand with good reporting, and boards need to start thinking more broadly, if they're not doing so already, about these wider implications. And then we have, and again, my personal thought is that we may see changes to the accounting. So in the US, we have the Sustainability Accounting Standards Board. So is there a role for a standard setter to start setting standards in this area? And then it just raises broader questions as, about expertise, and do traditional accountants like myself have the necessary expertise to be writing accounting standards in this area? And it's a whole it's a wider debate. And then, of course, we have digital reporting. So the FRC has an innovative department which calls itself the Financial Reporting Lab, which is part of the FRC. But basically what they do is they're not about policy making. Their focus is on providing a facilitation for preparers and investors to develop disclosures that meet the needs of both, and they frequently publish reports on specific topics. So currently they've got a project underway on business model reporting, and the idea is to put those two groups together and develop reporting that is useful for both, and provide insights to other companies on how things that they might want to think about. They are also looking at the whole digital agenda and how digital reporting can play a part in reporting. So that's going to be an interesting one to watch as well. And finally, if I just refer you to all our publications are on the FRC website, so the guidance on the strategic report is available. All our documents are publicly available, and if you'd like to read more about the Clear and Concise initiative, we published a document last year just talking about clear and concise reporting, but also developments in narrative reporting. And just to close, it's very nice to be here, and it's nice to see that Brunel has evolved, and corporate reporting will continue to evolve as well.
Thank you.
Thank you.